Well, welcome to the Startup Espresso. I'm Hall T. Martin, the host of the show, where we talk about raising funding for your startup and the time it takes to have an espresso. I hope you enjoy this episode. Hello, this is Hall T. Martin with the Startup Funding Espresso, your daily shot of startup funding and investing. In a VC fund, limited partners look for greater returns. The risks are higher and the hold times are much longer, so LPs look for better returns than the stock market. In general, they look for a 10 to 20% IRR better than the market index. Historically, top VC funds have a distributed paid-in ratio of 3x, while the total value to paid-in ratio is 1.5x, not counting the dot-com error. The manager of the VC fund can improve the performance of the fund in several ways. Remember, IRR is higher the sooner the funds are returned to the LP. A VC fund manager can increase the IRR by taking funds in a series of capital calls rather than all up front. Most funds ask for one-third the invested capital up front and then 2 more capital calls in the following years. In pledge funds, the LPs provide the funding for each deal as it arises. Another option is to shift some of the management fee into the carry. This will increase the return to the LPs. And 75% of VC funds do not return anything to the limited partner after the fees are accounted for, and most limited partners know this. Thank you for joining us for the Startup Funding Espresso, where we help startups and investors connect for funding. Let's go start up something today. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.